Today we have a legend in our community with us. One of my favorite nicknames, I would say, like just kind of like
You nailed that one.
nailed the nickname. But most importantly, somebody that has had extraordinary success with real estate investing. Greg was just talking about like this idea of somebody out there in the world that champions a message and speaks it the way that we do here, very, very natively off of a lived experience, remote investing, understanding how to get to that outcome, that everybody wants. The patron Santorios of the community, Michael Santorios. Welcome to the show, my friend.
Thank you. Thank you, Pablo. Thank you, Greg. Thank you for inviting me. I appreciate it. Looking forward to a good conversation.
Welcome everybody to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
I'm pumped for this one, man.
Me too.
I'm pumped. Michael, how you feeling today?
I'm feeling good. Thank you. I appreciate it. It's been a while. I was on a long time ago and looking forward to having a good conversation.
That being said, we kind of like recapped your story maybe a month and a half ago of just talking about like getting to this idea of going passive in remote investing. Can you give us like the 2-3 minute version of your real estate history up until the moment where you made that decision to not make it be your full-time job while you had a full-time job?
Yeah, no, definitely. And I've told people this before, so you may be hearing it for a second time, but back in 1989, I was actually selling women's shoes at Nordstrom. And my mom strong-armed me into buying my first rental property, which was a 2-bedroom, 1-bath condo in Parkside, little condominium complex in Bethesda, Maryland. I paid $71,000 for it, which my mom said that is a steal. But interest rates at the time were about 13%. And I said, Mom, I can't afford that. And so she ended up lending me, she actually co-signed. She lent me the down payment. She co-signed for me. And so in 1989, I bought my first piece of real estate, which I held for a couple of years. I was negative cash flow on that, but I was living at home, so it was no big deal. I could afford $300 a month. And then a couple of years later, the property value went up as interest rates came down. And so I did a cash out refinance. A couple of years later, the property appraised for about 100,000. I pulled out 80,000, which I had some equity from the renters paying rent down and equity in there. And I used that money to pay my mom back. And that left me with a little cash, and that kind of got my real estate career started.
Man, you know what? You want to know something? I did something very similar for my first purchase.
You sold shoes?
I sold shoes, yes. No, I didn't sell shoes, but the same way that you got started, I didn't have any money when I was 23. So I hit up my dad. And I said, Dad, I got this dream. I want to start a real estate company. It starts with this one property. And it was a property that my business partner, Alex, and I lived at. It was a condo. And it didn't end so positively so quickly as it did for Michael, but I borrowed the money from my dad and then I paid him back in future years. The only thing was I remember putting the projections about how much the property was going to go up in value and how I was going to refinance and then pull that money out to pay my dad back. Didn't happen so much because I bought this property in 2006. So 2008, 2009 happened. The value had gone down. So I had to work my butt off to pay my dad back. But you know what? We both got our first start in real estate the exact same way.
You gotta lean on your resources, and if it's mom or dad or a cousin or whomever, you take advantage of it while you can.
There you go.
Yeah.
People believe in you.
So, Michael, I remember the story kind of being like you got to a certain number of properties, right? Like you believed in the asset class, you did the work, you managed it all yourself. And then at a certain moment, you were like, man, I don't really want to do this all. And I'm not sure if I want to necessarily do it in my backyard even. Can you talk to me through that realization?
Yeah, so I eventually got out of the retail business and I moved into the high tech world. So in 1996, I started working for a small little startup company called Nextel, which paid me quite a bit of money, as back then cell phones were very expensive. They were $1,200 a piece and you paid by the minute. And so if you could sell one, you could make some money. And so being in sales my whole life, I was like, this is great. So I was making good money in 96, 97. And so I started looking at real estate as a way of putting some of that money to work. And so what happened was I started looking at properties in Ocean City, Maryland, which is about 3 hours east from where I live now. It's on the shore and doing week-to-week rentals. And so I was looking at properties there. I also bought another property in the development that I lived in. So I had that going for me. And then I met my wife now, Ann, and we got married. And so at the time, I had four properties, two in Ocean City, two in Bethesda. And while I was working at Nextel, and that just became an absolute full-time job. They were all HOA properties, so you had to deal with HOAs. They all were condos. They all required maintenance. They all required tenants, leases, everything that a property manager would do. I did have a property manager in Ocean City, but they were constantly having issues with lockouts or problems with damage. And anyway, it just was a full-time job. And my lovely wife actually did the numbers and said, we're not making any money on these after you're spending so much time driving back and forth for HOA meetings. And so that's kind of where it came to be. And so living in the DC area where I live now, one of the things that we've all experienced living here is you're going to get laid off at some point. Tech in the high tech world, you're going to lose your job at some point, or you're going to have to move on. And being in sales, my whole career, you're always 3 months away from being fired. So my wife and I sat down and we said, how can we replace our income? We had a young child at the time, and it's like, how can we replace our income if one or both of us lose our money? And so we looked at real estate. And so that's where I jumped into Fortune Builders in 2015. I met Gregg in 2016 and we started running the numbers, and I bought my first property I guess it was January, I believe, when we jumped in. And so that's kind of when we started. So I bought my first three properties in 2016.
I feel like I always learn something whenever we get the opportunity to chat. And your story just is so incredible for so many reasons as we're going to get into it. But what I picked up here is that Ann kind of called out the situation that you had with your properties in Bethesda and Ocean City, I believe. And she said, hey, the numbers aren't working, especially when you value in the time that you're spending on this. When was that, and how quickly did you seek out an alternative going to see Fortune Builders and then finding us? Can you kind of timestamp that for us?
Yeah, so in 2014, I was laid off because
Mhm.
Sprint basically dissolved the federal government sales team and they got out of federal government altogether. And I was on the federal government team. And so I was basically out of a job. And a lot of people were scrambling and they were running to the competitors, AT&T, Verizon, and whatnot, and other technology companies in the area. And I took the opportunity at that time. And Ann and she actually is the one that found it. And she said, this looks kind of interesting. And so I decided to kind of try out the whole Fortune Builder piece. And I think I met you in Houston or Chicago. I can't remember. I
Yeah.
want to say it was Houston. And so I went to the event down in Houston, sat there, and you were there. And there were some other turnkey operators there that I was very impressed with as well. But, I like Florida. I liked you and the team. I mean, I think you only had like 40 employees at the time, if I remember correctly.
Yeah, that's true.
And it was just very small. And, you scheduled a meeting with me and we had to sit down. And I think what I really liked the most, Gregg, to be very candid with you, was you weren't concerned about selling me one property, which at that time you were like, what's your long-term goal? Where do you see yourself 5, 10, 15 years from now? And you were the first person that ever really sat down and said that. And so I had said to you then that I'd like to retire by the time I'm 55. And I also expressed my concern about being in the high tech and the fact that I had just been laid off and my wife was on the bubble of possibly being laid off. The economy was turning. So that's kind of where we decided that we were going to kind of go all in on real estate. And I started pulling some money out of the market at the time and decided that at that time, you and I had a conversation. We decided on 10 properties. So we said, let's do 10 properties in 10 years. That was the goal. And so we laid out a roadmap on how to do it. And the goal was, let's get the 10 as quickly as possible. And then once we get to 10, we start paying down the mortgages as quickly as possible so that you have the cash flow, so that should you lose your job, you have the income. And well, that's where we are today.
There we go. I still remember those conversations with you and Ann. And I remember saying to myself, okay, they're asking really good questions when you're a salesperson like you are, Michael, and somebody's asking really good questions. You're super excited. So I think if I remember correctly, I think we put hours and hours and hours together into that plan. Do you remember that?
Yeah, we we did. We actually met, I think it was in December, and we started having weekly calls every week. We were like, okay, let's have a week next week, next week, next week, because I didn't want to do just one property. I wanted to do more properties. And so it was a matter of maneuvering. And I was thinking one property. And you were like, no, you need to do more than one property. You need to do like three right now. And I was like, I can do that. I actually sat down, and Anne's an expert at Excel. So she was the one that was crunching all the numbers. And so with her help and I sat down and we said, okay, let's start in. And so we jumped in with three. Then we went from there and then got one in 2017, got one in 2018. And then I was approached by one of my former colleagues that I used to work with over at AT&T. He had a job opening over there and he said, hey, do you want to come work over here? And I said, sure. So they made me an offer. I went over there. I took advantage of the W-2 paycheck and I bought, I think we picked up six properties with mortgages at that point because I had a W-2 paycheck.
Right.
And so that's in 2019, we got six more. And along the way, we did a 1031 exchange, which I don't know if anyone's familiar with 1031 exchange, but if you're not, you gotta learn how to do a 1031 exchange from a rental property so you can get out of a bad one into a good one, or even one that has a ton of equity. So did that. And then I think we bought, yeah, one more in 2020, and the last one we bought was in 2024.
If I'm doing the math there, Michael, that means that you started in 2016 trying to get to 10 properties. It sounds like you got to 10 in 2023 or 20, like that 2024. So like I was trying to do the math. It sounded like you just said number 11 there.
Yeah, we're up to, well, we have 13 right now. We actually, yeah, we have 13 in Jacksonville. We do have one in Maryland. Anne's mom passed away in 2022 and she left us her single family home, which we ran out as well. So we do have that one. So we've got 14 rental properties right now.
And just kind of, we're going to go over your portfolio and do the snapshot and all that later, but safe to say mission accomplished, right? You are retired, right? Are you already, did you retire by 55?
Yeah, so what happened was in 2020, obviously COVID happened and everyone needed cell phones. And so I was doing very, very well. And we were putting a lot of government customers needed phones so people could work from home. So I did very well in that first quarter of the year. And anyone that's worked in high tech knows that there's a thing called windfall. And if a company determines that you have a windfall, they may not pay you what they think you're worth based off your past activity. So there's not a lot you can do. And so when the push came to shove and in the middle of 2020, they were like, we need to adjust your quota. And I'm like, well, that's because I did my entire year's quota in 1 month. Um, no, don't adjust my quota. And so they decided they wanted to. And I was working 12, 14-hour days because I was killing it. And I said, at this point in my life, I don't need this. I don't need to be working 12, 14-hour days. I have a young child. I got a wife. I have, family in Maryland I want to spend time with. And, I don't want to work that many hours anymore. And so Ann and I sat down and we had a heart-to-heart conversation. We decided, you know what? We don't have to do this. And so I pulled the plug and I said, I'm done. And so I went all in on real estate. And of course, we do private money lending with JWB as well. And we have some syndications that we've done as well. And so, yeah, we just decided that was it.
Congratulations. When I think about like why I started this company, why we started this company, it was in the future. This was 23-year-old Gregg in the beginning, but it was like, in the future, I want to have an impact on somebody just like this story, right? Somebody who started, and I think it's really interesting because the numbers that we talk about with rental property investing are really strong. We'll take a look at Michael's numbers here, but his story is about having the optionality to do what he wants when he wants. When there is an obstacle that is presented to him, for him to have choices. And that started back in 1989 with your mom who ushered you into this,
Yeah.
but you made subsequent decisions that were deferred gratification decisions to continue to buy rental properties, those four that you had maybe 7 years later. And then when you stumbled a little bit and realized that it maybe wasn't the most profitable way to do it, you had an easy out to get out of it. But you doubled down. You went and you invested in your education and your relationships.
Yep.
You followed the plan. You obviously found somebody that you could trust. And now when that obstacle comes at, age 55 or there, and somebody says, hey, I need you to do this, you have the optionality to say, you know what? I'm good. I'm going to choose option B because I've prepared for that for 10 years, 20 years. So Congratulations, man. This is everything that we wanted JWB to be about when serving our investors.
No, no, I appreciate it. And I don't want everyone to think it was always, smooth sailing the whole way. There were quite a bit of hiccups along the way. I mean, I did go through a divorce back in 1989. I'm sorry, 1998. I did go through a divorce. So that threw a monkey wrench in my plans, and I had to sell my primary residence. And so there were a lot of hiccups and glitches in there, but I've always been a big believer in real estate. I know real estate is not for everybody, but for people that are open-minded and willing to listen to people that have been successful in it, I really don't see how anyone can look at real estate and I mean, if you look at history, it dictates that real estate has been one of the greatest wealth builders in the history of time, in my opinion. I mean, there's an old book, The Millionaire Next Door, and I want to say like 40% of the millionaires have made their money in real estate. Yeah, you can do it in the stock market, you can do it in starting your own business, sure, but there's a lot of risk in those things. And, from a risk perspective, real estate has proven over and over and over again. And you're going to have hiccups. You're going to have glitches. I mean, Fritz and I are going through a situation right now with I have to get an entire house rewired. It's okay. It happens. Things happen. You'll have an eviction. You're going to have a problem. There will be problems. But you just kind of expect that. And when there are no problems, yeah, great, but you just kind of hold tight and stay on, keep going.
All right, so let's talk about that. Let's talk about this idea of having problems and it's not for everybody. Michael, do you think that you do something different when it comes to kind of like managing the emotions of it or like setting money aside for moments like this, stuff like that?
Yeah, you have to set money aside. And again, I'm going to have to give my wife credit. Or maybe she should be on the call instead of me. Um, what we did is we sat down and we ran the numbers. And because we've had a lot of history, and you guys provide really good numbers through the portal, so we can see how much money every year we can spend. We spent on maintenance and repairs, so we can look at it and say, okay, we need to allot certain amount of money. So before we pay ourselves, we want to make sure we have a certain amount of money set aside. And you guys hold a certain amount of money that we just say, go ahead and do the work. That's fine. And I'm a big believer in we had a refrigerator go out in one property, and Fritz came back and said, do you want to put a refurb in there or a brand new? No, I want to put a brand new in there because the difference between brand new and refurb is like $250 or $300, but the tenant is going to be so much more appreciative of a brand new refrigerator coming through that door. And then I do a little thing where if somebody signs a 3-year lease, we send them a $100 gift certificate to Publix just so that as a thank you, just to make them feel, welcome because, they're helping me and I want to help them. And so, if there's a problem with a tenant, like during COVID, you guys had some situations where people were having struggles and, we worked through it. We gave people opportunities to play catch up over a period of time. And so those are the kinds of things that happen things are not perfect. You're not going to get paid every single month for 10 years. It's not going to happen. And so we know that. So when somebody signs a renewal that's 2, 3 years, we want to say thank you. If somebody has a problem, we want to get it taken care of immediately and make sure that they're safe and they're happy and so that they don't want to leave.
I think there's the mindset that Michael and Ann have adopted here, which is leading to their success. And then there's the movement of the money too. And I think reserves are something that many people don't fully understand, don't fully execute. It can lead to customer service issues when folks are not prepared financially for reserves. Michael, could you share your approach when it comes to reserves? And then maybe share some lessons learned over the years, maybe when you underfunded reserves, or if you feel like there have been times you overfunded reserves. I think that would really help folks.
Yeah, so the way we've been doing it is, she's the one that's in control of the numbers, the actual numbers. But for example, we've got 14 properties, so we try to hold no less than $15,000 in there. And the reason we came up with 15,000 is in the past we've had to have a new roof put on. Okay, that's a couple of thousand. Right now, we're going through an entire, the property, we changed insurance companies. The insurance company did an inspection, and well, the rules have changed since 2020. And it just so happens that property was built a long time ago, and we bought it pre-2020. And so the wiring in that house is not up to par. And so we want to rewire the house and make sure that it's safe. And that's going to be an expensive fix. So that's like $13,000. So we've always just kind of held 15,000. and which is, about $1,000 per property, just in case. And, that's the number that we came up with. That's the number that works for us. And then anything over that, we can determine whether or not we want to, we can pull some money out for our salary. We can do more private money lending, but that's kind of our bucket. Once that bucket is full, then we can start looking at other things to do with that and go from there.
That's critical. That's actually the number that I would suggest, not even knowing what number you were going to suggest. 15,000 for a portfolio of 14 properties. And also understanding how your portfolio produces positive cash flow, and you do have some properties that are owned fully in cash. These are things that allow you to have $15,000 in your reserve account and not need 30,000. In a general rule of thumb, if you want to make sure that you don't have to come out of pocket and it's not guaranteed, but if you want to kind of put the right amount so the chance of you have to come out of pocket are very low. I tell people, when you buy a rental property, put $5,000 in a separate bank account for each property until you get to 3 properties. After you get to 3 properties, what you're looking at is, what are the chances that I'm going to have a one-time $15,000 expense? And it's quite rare for properties in Jacksonville, Florida, right? You could have multiple properties that move out at the same time, and large property turns, sure, it could happen, but the chances are quite rare. So fund your account up to the point where the chances of you having a one-time hit are quite rare, and you're going to give yourself that wonderful experience of continuing to have money go into your account rather than taking it from your personal bank account to spend on rental property. So there you go. I think
that's exactly what we did, literally. And again, Greg, we got to go back to the portal, the owner portal that you guys have. Thank you for allowing us to export it in Excel, which is a brand new feature. It used to be in PDF, and that was a nightmare, but now we can Excel it out. But it gives Ann the opportunity to look at the past maintenance history of the properties, and we can break it down by year and everything like that. So we kind of got a good trend, and that's kind of how we came up with 15. So there you go. Your numbers are just right where I would say.
Perfect.
Michael, one of the things that we talked about on the show, is this idea of remote investing, right?
Yeah.
And I wonder how you think about it. I know that it sounds like in your story, you went and got the education with Fortune Builders. Because of Fortune Builders, you got to meet Gregg. It sounds like it was very much like a trust-based, relationship-based decision for you.
Absolutely, yeah.
Yeah. So which is in line with our order of operations, right? Like our order of operations is, instead of property, market, team, it's team, right? Like find the person you really, really trust, then make sure that you really like the market, then you pick your properties. Can you tell me about how you think through market these days, right? Like why Jacksonville? Why not other places? Stuff like that.
Well, so being in sales, people buy from people. And, I'm not going to buy from a website. So I get emails all the time. Here's great real estate in this market, great real estate in that market. But you learn from people. And so getting educated on the markets, like, for example, some people talk about Nashville. Well, okay, people talk about all these markets. But what I've learned over the years, and again, this is from meeting the JWB team, is the people that are managing your properties are very important, but what it's more important is, how are they, your property manager, how are they making their money? And so what I found was, when somebody said that, I was like, well, wait a minute, that makes really good sense, because I said, JWB makes money every time I buy a new property, so it's in their best interest to do everything in their power to make me happy, so I buy another property. Where these other property management companies, I noticed they were turning properties. They make money on the turn, where they making money on the maintenance. So it kind of led me to believe those might be good markets. I'm not saying they're not bad. Those are good markets. But when push comes to shove, I don't want to be a full-time employee of my own company. I want somebody else to take care of it. And if JWB is going to take good care of my properties, they're going to give me a good portfolio manager, they're going to give me good reporting, they're going to help me when it comes to tax reporting and whatnot, and giving me my good end-of-year statement. Those are more important to me today in my life than it is going out, finding a property that's priced really low that I can throw rent in there and get a great ROI, but I have to put a new tenant in there every year, and I got maintenance issues because it wasn't maintained up until the point that I bought it.
Sounds like what you said, right? Like
Yeah.
somebody that like talks our language, right?
Oh, 100%. You go through those criteria, and the criteria that Michael abides by and that we abide by are there for a reason, because start with the team, because if you have a bad team, it doesn't matter how good the market or the property is.
That's right.
Right? If you have a market that might not be the best market, but you have a great team, you still can come out okay, or you'll still be in the game long enough for that market maybe to rebound. But if you have a bad team or not even a good team, there's no way you're going to stay in the game long enough. There's no way that it can overcome a market deficiency or the best market possible. And the way you win in rental properties is by staying in the game. Michael and Ann are clear examples of staying in the game and then reaching that financial outcome.
I take a special kind of like sense of inspiration from your story, Michael, in the sense that it sounds like, when I started investing in properties and I picked up my first three was not my peak earning years. In fact, it was the opposite, right? Like I got in at a time where I was just like, man, I'm doing all this risky stuff. I need something safe. And obviously the team thing was very real for me because I get to see the team every day here. And I also was living in the Jacksonville market, seeing special things happening and wanting to set myself up for success. But what really inspires me from your story is that you've been able to take these like inflection points, right? Like I was just talking to Gregg about doing Pilates with him on weekdays, and he's like, "Why hadn't you considered this before?" And I was like, "Gregg, I was in a different financial position before, right? Like now, as I'm reaching this point in my life where I am a high earner, and I do have these like what we were talking about before the call, Michael, this idea of just like, well, where am I going to put my cash moments? It's really, really inspiring for me to hear, there is like, as long as you're in the game and this thing, it's doing its thing, the moments in your life where you get those extra windfalls and you get those extra moments to like push more chips into it continues to compound in ways that are non-linear. Like I hear your story and it was like, it sounds very non-linear. It sounds like you started in 89, kind of like,
Yeah.
you built up a little bit, and then 2016, you went back in for a big bite of the apple. And then again in like 2020 to 2023, and boom, you're freaking retired, man. Like it's really impressive to me.
Well, I always say real estate it's a long, boring road. It's very long, it's very boring. You just kind of have to make sure that you're in it for the long haul.
Doesn't he just speak my language?
He does.
Long, boring, stay in the game for the long haul. It's like we're brothers from another mother, man.
And Pablo, to tag on to what you just said a second ago is, during my peak working years, I was making good money. When you're making good money, you don't need to be making a ton of cash flow off of your rental property when you're making good W-2 money, because that just means you're putting yourself in another tax bracket. If anything, you want to have as little cash flow as possible. So you want to grow your portfolio as fast as possible. Every dollar you get, put it into another down payment, another down payment, another down payment. So if you're making $300-400 positive cash flow, that's great while you're making good W-2 money. Because then you can start paying those off when you stop working, you're not getting taxed. Because if you go out and you're making good money and you pay cash for a house and you're making an extra $1,500 a month, you're paying full-blown tax on that $1,500 cash flow a month, as opposed to paying tax on $300 and building equity.
It's a really important concept. And I don't know if we've ever talked about that
Yeah.
specifically, but when we talk about tax savings, you get so much more tax savings by buying financed properties than you do by buying properties in cash, which is what Michael's talking about here.
Yeah. Yeah.
And the other thing, Gregg, what I also learned is, and this, I have to give my accountant credit for this one, is, the properties in Jacksonville, the land value in Jacksonville is not as expensive as oceanfront property in Ocean City, Maryland.
Right?
So when it came to depreciation, I was able to take the same dollars and move it to another asset and get a better tax depreciation, because if you bought, let's say, a $250,000 3-bedroom, 2-bath, single family home in Jacksonville, that might be $50,000 in land value and $200,000 in depreciation, where that same money up here, the majority of that equity or value is in the land, not the structure.
That's exactly right. So now what he's talking about is when you calculate your tax savings, you're only able to depreciate the building value, not the land value. So in Jacksonville, the land value is a lot lower on a percentage basis than up in the Northeast. And so again, the tax savings component by choosing a market which has lower land values like Jacksonville actually leads to much greater tax savings as well. This is all like, you know, rental property investing. Like this is the 301 class that
Let's take a
that
301,
Michael's
yeah.
teaching right now.
Yeah, good stuff. Speaking of 301, I want to just call attention to the Jacksonville Q2, Q3 2025 real estate market report. Before we dive back into your story, Michael, I just kind of want to promote this thing. As I've like studied what's going on, I'm sharing a link in the chat for anybody that hasn't downloaded it yet. I want to show you kind of like where you download it, and something that Gregg and I were talking about, right? Like when you look at a lot of data, there's a lot of these national reports that have things that you can find everywhere. And as I've gotten deeper and deeper in the property management industry, what I've realized is that actual localized rent rolls and pricing and like hyper local, which is really what real estate decisions are made of, are really, really hard to find. This report is something that is unique because JWB has 6,000 doors inside of a market, and you're able to like tease out this behind the scenes stuff that most people, analysts, you can't really buy. And this is just somewhere that you can get this. And it's like a really rare thing. So really want to encourage folks to dive into these numbers and see what's happening in Jacksonville in a really, really unique way.
Yeah, I'll just add on to that real quick. If you're thinking about putting your money in rental property investing in Jacksonville, or if you already have your money in the Jacksonville market, this is a report that you need. It's not too common that a company, we are the largest single family residential property management company in Jacksonville, manage over 5,500 doors. And we can use all that information to tell you about what rents are today, what are rents looking like come 2026, what are prices doing today, what are prices looking like coming towards the end of this year and then in next year. This is a report that should be in everybody's hands.
Yeah. And if you're listening on the podcast, that's at jwbrealestatecapital.com/report, jwbrealestatecapital.com/report. Michael, you're always telling us we got to sell more on the show, man. How do we do?
I think you did great. You did great. And I just to tag on what you just said, you know, what I love about that is the fact that you're selling Jacksonville. You know, going back to when I was originally looking to invest in real estate outside of the DC area, I looked at other markets, and a lot of those companies were not focused in one area. And I have to say that was one of the main drivers for me because, you know, one of the companies I was looking at investing with was located out in Nashville. And I realized they don't just do Nashville. They don't do just Tennessee area. They do multiple locations. And I'm like, that's, you know, and they don't have operations in every area. So I was just a little put out. And so I was like, I like the fact that you're focused on Jacksonville and Jacksonville only. I love the fact that you guys are focusing on developing. You have a separate division that focuses on downtown to build out downtown, to giving back to the community on a regular basis, you know, giving away homes like you guys do, then helping out with the community. So just the outreach is a wonderful piece as well, because it makes you feel good and it makes a difference in the neighborhood.
Thank you, buddy.
I know the team's going to love hearing that, man.
Yeah, that's what motivates us.
Yeah. All right, Michael, I want to shift focuses before we get into your overall, kind of like portfolio breakdown. You are kind of like the king of referrals for JWB,
Yeah.
right? I, as the mouthpiece of JWB, has a giant goose egg when it comes to referrals. I was just intimating with you that I have zero luck convincing anybody that doesn't watch me on the show already to like get into this thing. And I am just really curious of how that happens. I know that you kind of you've got like a group of guys inside the DC area. You have been very influential to them. What is it like? How do you actually convince people? Like, what are you telling people that actually gets them to get it?
So a lot, you know, I live outside the DC area. I'm in Chantilly, Virginia, right near Dulles Airport. I live in an area where if you take the Beltway from Washington, DC, I-66, 495 area, and you head towards Dulles Airport on the Dulles Toll Road, you've got high-tech company after high-tech company. You got Google, you have Blue Orchard, you got Facebook, you have data centers all over the place. I mean, there's a lot of people that make a lot of money around here. And everyone talks about their quote unquote portfolio. That's a big thing. And a lot of people don't think of real estate. They think of, you know, I like to just look at my portfolio statement every month. And a lot of people don't realize that these financial planners that they're investing their cash with, they're getting charged, 1%, maybe sometimes more than that. And when they do the math, sure, they're making money on their portfolio going up. They're also paying a lot of fees to that portfolio manager for managing that portfolio for them. But what people are also forgetting is, and I always tell people before you invest in anything, whether it's a stock, a bond, or whatever, even if you're putting money in a savings account, what's the end game? So when you buy a piece of real estate, what's your end game? Well, if you're putting money in your 401k, the end game is when I retire, I'm going to pull money out. If you're putting money in an IRA and you want to pull that money out, is that going to be taxable income when you're retired? It sure is. And if you're putting money in the stock market and you're watching these stocks go up, when you sell those stocks, those are a taxable event. So what's your end game? Yeah, you might want to go, oh, yeah, I have this Nvidia stock, I'm up 5,000%. Great. Now what are you going to do? Are you going to borrow against it or are you going to sell? And what are you going to do? So with real estate, it gives you all those benefits of an appreciating asset. And I don't know of any piece of real estate that's ever gone to zero. I have actually invested in stocks that have gone to zero. So
Me
when it
too.
comes to selling, yeah, when it comes to selling a piece of real estate, you can avoid tax. When it comes to selling a stock, it's very difficult to not pay tax. In fact, I only know of one way to do it, and that's, very complicated. So your end game is so that's why I always believe in having a balanced portfolio. Maybe don't go all in on stocks, put some money in real estate, but don't go all in on real estate, put some money in stocks, but being very balanced in your investment portfolio. But before you invest in anything, what's your end game? And when you do tap that money, it's going to be taxable. And you want to make sure that if you are going to be taxed on it, you can control it. And with real estate, you can control it. And being a depreciating asset, I buy real estate to carry it for no less than 10 years. My goal is to carry it as, until it's no longer giving me the return based off of the value. And that's why when Ian said, let's sell these places, they're worth way more than the rent that we're getting. So we were like, wow, we could actually double our rental income after taxes, insurance, HOA, and everything just by moving to Jacksonville because the taxes are cheaper. There's no HOA and we get a better depreciation. So it just made perfect sense. And that's where it came in.
So what are like the actual logistics of maybe a friend in your network or whatnot expresses some interest? What do you do next? Do you take them out for coffee? Do you show them your portfolio? Like what, if you wouldn't mind, just like the nuts and bolts, like how to make a great referral.
Well, I have a big network of people that from being in sales that, a lot of time, like I said before, people buy from people. So the people in my life who I've talked to and sold products to in the past, they're still friends. And,
Hmm.
I still communicate with them. And a lot of people that I worked with have gone off and they've been very successful and they've, moved up the ladder and they're making a lot of money. And I always tell them, I said, you're making a lot of money, but look how much you're paying in taxes. Yeah, you own a beautiful single family home that you live in, but all your money is in the stock market and you're making really good money every month. What are you doing with that money? You're just plowing it back in. So I just have those conversations with people. And it's not like I'm trying to sell them anything right now. I'm just trying to help them realize that because everyone around here complains how much money they pay in taxes, but
Yeah.
nobody knows how to lower it. And I'm just giving them an idea on how they could potentially lower their taxable income. And I'm 58 now, and a lot of my friends have kids that are graduating college or graduating high school, and they're no longer have their kids as depreciated, and they don't have that anymore. And so their taxes and they a lot of them have extra cash coming in because their kids are
Yeah.
graduating college. So they're not
Yeah.
paying college tuition anymore. And they're looking to retire. So it's the interest. It's the
Yeah.
interest in kind of trying to duplicate what I did.
And you're speaking their language. I heard taxes like 37 times there, which I love talking about reducing taxes. And it sounds like for the folks that are in those life experiences that they're in, I didn't hear you once talk about, hey, you can earn a super great rate of return. I didn't hear you say, oh, your cash flow is going to be phenomenal. It's
No.
those things are there. Let me help you reduce taxes, So just understanding, I guess.
And Greg, one thing I'm very forthcoming with is I'll sit down and I'll pull up my portfolio and I'll show it to them.
Hmm. I bet that speaks volumes.
Yeah, because I say, look, you can trust me on what I'm saying, but let me show it to you.
Yeah.
I'm just going to show you. And, you can look at the tax records and see when I bought something. You can see how much I paid for it. You can see what the value is today. So it's not like I'm lying to you. I'm
Yeah.
just showing you what I did. If you want to do it, great. If you don't want to do it, don't.
Yeah.
I think this is a perfect time to show your portfolio.
Let's do it.
Sounds good, man. Michael, when's the last time that you took a look at this thing holistically?
It's been a while. It's been a while. Yeah.
It's been a while. All right. Well, there's a handsome fellow right
How about
there.
that dashing
That's
young
an old
lad?
picture. That's an old picture when I was
I don't
at the
know.
U.S. Senate.
I like it. So before we show these are real numbers. We're not financial advisors. Do your own research when you're investing in stuff like this.
Well
Did I
said.
miss anything there?
Nope.
All right, cool. Is this what you show them, Michael? You just show them like, here's all the properties that I own right here.
Like, first of all, I'll just say this before you answer that. Michael, you made it really hard for me because when I'm putting slides together, I'm trying to make them visually appealing. But with the vast number of properties that you have bought with JWB, you made it really hard to do. So I know
Sorry about that.
these
Sorry.
numbers,
Yeah.
but it's Michael's fault.
So Michael, is this what you do? Do you just kind of like go through and talk about each property? Like how do you show your portfolio?
Pretty much what you're looking at right there. I just kind of start there just to give them an idea of the fact that this is not real estate is not a silver bullet. You can't just go out and boom, make money right out of the gate. It's a long process. And so I show them the history and I'm like, you got to jump in at some point. Just jump in. Jump in today. Get in as soon as possible because if you got a 10-year horizon, it gives you 10 years. And what you're looking at right there is, that's 9 years.
Yep.
Just
Yeah,
about.
Yeah,
Just
9 years. So it shows you got in 2016. You talked about these first 3 properties that you bought. You bought them in cash. I guess was this like you sold your properties in Maryland and 1031 them down here?
That's correct, exactly. And one of the properties that I sold was a 3-bedroom, 2-bath condo in Bethesda. I bought it for $175,000. And when Ann and I got married in 2005, I sold it in 2007. I sold it for 355,000. Well, I didn't have to pay any capital gains on that because it was my primary residence for 2 of the last 5 years. Even though I rented it for a couple of years, I had still lived in it for 2 of the last 5 years. So I was able to take advantage of not paying any capital gains. So I had the cash sitting on the sidelines ready to go.
So there's huge tax savings opportunities that Michael has just dropped, these nuggets, and it comes with investing in his education and his relationships. Michael, can you explain that one more time? The strategy there, living in the home for 2 of the 5 years, and then also just a brief explanation of a 1031 exchange for those who might not be aware.
Sure. So what happened was the 3-bedroom, 2-bath that I had bought in Bethesda, I had already owned a rental property in that area anyway. So when I met Ann and I moved into her townhouse in Reston, Virginia, I rented out my place knowing that I had a time limit. So if you sell that your primary residence, you don't have to pay capital gains tax up to $250,000 for a single and $500,000 for a married couple. So I knew I had $250,000 worth of gain that I could take without paying any capital gains. But what I wanted to do is I wanted to hold the property a little bit longer so that it could appreciate because I saw I sold it in 2007. The real estate market was booming in 2005. So 5 to 7, it was going up in value. And so sometimes you're better off lucky than good.
Yeah, you timed that perfectly.
I was very lucky. Well, I was very lucky that I sold it in 2007, but Ann and I also sold her townhouse in 2007. And that's where we bought the house we live in now. Granted, we paid 2007 price for this house, but we've been living here for 18 years. So we watched it go down and go up. But the bottom line is we didn't have to pay capital gains tax on either of those properties because it was our primary residence for 2 of the last 5 years. When it comes to a 1031 exchange, I took one of the properties I had in Ocean City, Maryland, and when I sold it, I had depreciation, I had asset pay down, I also had, just regular pay down. So I had some capital gains there as well. But instead, because it was an investment property, I took the capital gain from that property and I rolled it into the JWB properties through what they call a 1031 exchange. You have to use a third party mediator. You cannot touch the money. So I identified the properties I wanted to buy first, or at least work with you guys. And what was nice is you had a nice selection to choose from. So I sold the property and did the 1031 exchange within the time limit and was able to pay cash for those properties. Between the cash that I had from the 3-bedroom, 2-bath, the cash I had from the place at the beach with the 1031 exchange.
You probably saved, I don't have the numbers in front of me, but hundreds of thousands of dollars in taxes through those opportunities right there, which contributed to your ability to buy however many we bought right off the bat, 3 or 4.
Right.
If you weren't aware of those strategies and hadn't invested in your education, your relationships, been a part of groups like this to learn this, you would have wound up with, let's say, 2 properties instead of 3 properties, just simply because you were able to save the tax dollars and then put them into an asset, which is such an incredible strategy, especially when you couple it with a buy and hold strategy. It's one of the reasons you're sitting here retired at 58.
Right. And Greg, the reason why I was able to, those properties that I had in Ocean City, I actually paid those off because at the time I was single, I was making really good money. I was living in a place I paid $175,000 for. My rent was next to nothing. And so I was making good money. I was able to pay off those rental properties. But then when Ann looked at the numbers and she said, you own these properties free and clear, we're sitting on like $300,000 worth of equity that's only generating after taxes, after maintenance, after HOA payments, because we had no principal, we had no interest. We're still only making like $10,000 net. So we moved all that to Jacksonville, the same money, and that's how we were able to increase our monthly cash flow. Well, that monthly cash flow again gave me the opportunity to build up cash reserves for another down payment.
That's beautiful. That's beautiful, man.
Outstanding. And then we see this, what you just talked about, right? 2019, you had a high paying W-2. You leveraged that in order to get a bunch of conventionally financed properties
And
all
I
at once.
put down the minimum. I put down, I think it was 20 or 25% in those, and I was cash flow positive just a couple of $100 when I bought those.
There you go. There
Did
you
you
go.
did you refinance any properties that you bought with us in cash during the really low interest rates
You
of
know, Greg,
2020?
I contemplated it, but I did not. And the reason why is because I knew the end game. I knew that eventually I would probably, and I had pretty good interest rates, at the time that on these properties when I got them.
Mm-hmm.
Well, granted, at the time, I want to say it was the high fours, low fives of what I'm paying on those now.
Yeah.
But I did not know because I wanted to maintain that cash flow, historical cash flow, because I knew that the job I had at the time potentially could come to an end. I didn't expect to come to an end so soon.
Makes sense. And so those first 1, 2, 3, 4, 5 that you bought in cash, you still own them free and clear at this
Yes.
time. Yeah,
Yeah.
gotcha.
Still, in fact, yeah. In fact, a Honda I just paid off too.
There you go. So, and that starts with starting with the end in mind, building the plan that Michael, Ann, and I put together many, many years earlier. It was about this outcome. And when we got to a certain number of properties and we understood what amount of rental income, net rental income, those would kick off, and it met their goal of lifestyle, well, then we don't have to go and refinance all of those properties to pull out cash to make additional investments. We're sort of already there. And so, and I would imagine, Michael, if I'm getting it correctly, that's probably why your last 2 purchases were cash purchases as well. It's because you're at the target number of properties. Now it's just about distribution of those assets for you to be able, the rental income, I mean, for you to be able to live the lifestyle that you want.
You hit the nail on the head, Greg. So what happened was, as you just stated, yes. So we reached the number we needed. We were making the cash flow we needed. It just so happened that during COVID, rents went up. I mean, geez, what, like 20%. So
Right.
our cash flow was through the roof on those cash flow properties. The $300 a month jumped tremendously. So we accumulated a lot more cash. We were able to buy 2 more properties with cash. As you can see, in 2020, we bought 1 more. 2024, we bought another. Well, I just paid off the loan on Honda. So we own Honda free and clear now.
So let me ask you this. You're 58, you're retired, and you have some cash that you're sitting there. Now you decide to take that cash and buy 2 properties fully in cash. An average investor would take that maybe to the bond market and buy bonds. Why did you decide to put that in cash and rental properties and not in something that's more traditional? I'm teeing you up here.
Part of it was that JWB was offering a pretty killer opportunity. If you bought property, you got a maintenance credit. So the maintenance credit kind of helped with that as well. I also looked at the rents at the time, and so I'm also trying to. This is what I control, and so the simplification of the portfolio is also key. You don't want to have too many irons in the fire. You can have. We have a financial manager that manages our portfolio there. And we've done some things with other assets, like I said, but I'm more comfortable with real estate. I tried my hand at syndication with commercial properties. I don't like it. I don't like being locked in for that many years and having zero control. I like real estate. It's, I'm not going to go out and buy 400 properties and go all in like you, Greg. But, for me, I like having a couple irons in and being in control a little bit. And that's kind of the path we took.
And it's clearly working.
Well, speaking of clearly working, here is the snapshot, right? So you want to talk them through this, GC?
Yeah, absolutely. So this is the scorecard. How have we actually performed? Or how has Michael's money actually performed through this beautiful asset class? And as you can imagine, lots of success here for Michael and Ann. This 13% rate of return means that every single year their money is working hard for them at a rate of 13%. And when you invest, like Michael and Ann have invested, and you simply buy and hold, and you're in an asset that's making double digits over and over and over again, that's how you get to your retirement goals, your financial outcome that you have. Total profit is over $1.8 million through his investments here with JWB and Jacksonville rental properties. And the way that that is broken down is something, it's a theme that we talk about over and over and over again. It's called, what's it called, Pablo?
The Pac-Man.
Pac-Man.
There we go.
Yeah.
Michael, do you want to explain the Pac-Man principle?
No. I'll let Pablo. He's the expert.
He loves it.
I do love it. I do. It is one of my most successful languaging
Yeah,
of
you
the
like
show, right?
I love
So, 5 profit centers, hard to put inflation hedging here on this pie chart, but when you put the 4 profit centers on a pie chart, you see principal pay down, you see tax savings, you see net rental income, and then you see home price appreciation. And home price appreciation, while Michael, you've bought a bunch in cash. You've done great with cash flow. You're obviously retired and you've made almost $500,000 in cash flow. Still, the home price appreciation makes up more than half of the total return in the pie. So when you put it in a pie chart, it looks like the Pac-Man and everything else looks like the mouth of the Pac-Man.
Well done. Well done. I'll point out the other profit centers and just a couple other things. So of the 1.8 million in total profits, about 1.3 is home price appreciation, as everybody can see here. He has about $82,000 in principal pay down. That is by investing in cash flow positive rental properties. That is your renters paying your loans down for you. And for newer investors, and maybe some who aren't so new, it's hard for people to conceptualize. But every time that the money is paid by your renter and it comes to you and you have some left over, which is positive cash flow, and then you in turn pay down your loan, what's actually happening is your renter is paying that principal down for you. And it really adds up almost a little over $82,000 for Michael and Ann. And then the last thing I'll point out, and then Michael, I would just love to get your thoughts on what you see here, tax savings. We've talked a lot about tax savings on the call here. The tax savings that we're talking about here is simply what this portfolio is producing in terms of tax savings, meaning the rental income that Michael and Ann received is offset by the depreciation and the tax savings components that allow him to write that off in that year. When Michael is talking about things like a 1031 exchange or being strategic about selling his primary residence after he has lived in it for 2 of the last 5 years, those are just additional. Those are advanced tax saving strategies on top of this that real estate allows you to do. So if we're talking about Michael's actual tax savings number, because he implemented these other strategies, it's even way higher than that $45,000 number. Michael, what do you think when you see how well you've done?
No, I'm right there with you. It's exactly what the reason why I love real estate. It's exactly what it is. And, you got to have a good accountant. You got to have a good financial planner. And I think you got to have a good portfolio manager and a property manager as well as part of your network of people. Everyone helps everyone. And that's the keys. It is the end game. What is your goal? And, when you and I met in 2016, my end goal was to be where I am today. And, we've achieved it. And so I like to share the wealth, and that's why I agreed to come on. And that's why I try to refer as many people as possible, because it's not reinventing the wheel. It's just telling people there is a wheel.
It's the patron Santorios, y'all.
That's why it is. I just love these conversations, Michael. It's been great, man.
Denny Davies says, that's amazing cash flow, only going to accelerate as Michael pays off even more properties in retirement. Michael, are you doing like C3X and paying off aggressively, or are you just kind of like letting this thing ride, or what?
Yeah, so what we do is we accumulate the cash until we determine what we want to do. We've done a number of JWB private money loans, and JWB is wonderful at flipping those properties as quickly as possible so that the money keeps coming back a little faster than we anticipated. So we have to determine, do we want to go back into another private money loan, or do we want to pay off a property? And so we, every couple months, it's a little bit of a determination. But I think for everyone on the call is just, get on these things and learn the terminology and learn how real estate can save you taxes. Taxes are one of the biggest money eaters that people don't realize, that real estate can help you not pay.
Mic drop.
That's good.
I love that.
I love it too. Jared Krishman's got a question for you. He says, Michael, what a great story. Just curious, is Ann retired now as well?
She is retired, and she does a lot of charity work, and we've got a 15-year-old daughter. We got married late in life, so we didn't have our daughter until I was 42. So she's 15, she's going on 16. She wants a new car, but no, a Toyota Corolla or some, beater box. I had a 1977 Mustang too that you had to hold in second gear. So she's not getting a new car. She's getting, but yeah, it gives us the opportunity to do that. My mom is not doing so great, so I get an opportunity to go spend some time with my mom as well. So she lives in Maryland, about an hour away. So I get over to see her at least once a week, and then obviously spend some time with friends. Because the bottom line is, we work our entire life in order to enjoy life, and you want to enjoy it while you can still enjoy it, not when you can't. And that's what I really hopefully can give some people advice is plan for the future, but try to do it as soon as possible.
I love it, man. I love it. This has been a really, really awesome show, Michael. It's so good to have you back here. I want to thank the community for being back. We got Denny back. We got Lee back. I feel like
I haven't seen Denny in a while. Denny, we have missed you, brother.
Yeah, Denny was just in the middle of a move, but he's back asking great questions, being great members of the community like you do every single week, Michael, man. So this is just a really, really great show to have. Any kind of any piece of advice before we do our final call?
Yeah. I think the community is a wonderful community. I think people should start inviting people to these calls, really do, because I think everyone on this call is a big believer in what we're talking about. I love the fact, unfortunately, I wasn't able to attend the the Not Your Average Investment show in person, but I was there 2 years ago. Just, I think growing the network of people and sharing the good stories, but not just the good stories, but also like the challenges. There's a lot of problems that people run into, and share those challenges. And one thing that you and I talked about earlier is people don't talk about how much money they lose in their portfolio on their stocks and their bonds, or when the stock market's tanking. But when somebody loses money in real estate, they will tell the whole world, and it just scares people. But you just have to not listen to take everything with a grain of salt. There's going to be problems in every investment, and real estate is not that scary.
Love it.
Michael, your story means so much to me, not just from the friendship we've developed over the years, but I just wanted to say thank you for giving us the opportunity to kind of live out our dreams as a business. When we get to have this type of impact on folks and they're a part of our lives for, 10 plus years, 20 years, this is where this is filling that bucket that goes way beyond dollars and cents. So Thank you not only for trusting me and the team early on, but thanks for giving back over and over and over again and meaning so much this community, brother.
Oh, no problem. Thank you. And I do want to give a shout out to my portfolio manager, Fritz. He's the bomb. He's the best. I couldn't ask for a better guy. Wealth of information, great communicator, which is key. Being in sales, communication is king.
Fritz is great. A lot of love coming in the chat, Michael. I don't know if you got a chance to see that. Next week, we are going through, we talked about 1031 exchanges. We're going through how you pick properties for a 1031 exchange. So we're going to do a portfolio of the week and go through the property selection tool under the lens of a 1031 exchange, so everybody sees how that is done. Hope to see everybody next week. From now till then, Michael, give us the call sign. What do we say to everybody?
Don't be average.
Don't be average.
See ya.
Y'all next week.
Yeah.